Whenever watching the news or reading a financial paper, have you ever come across the term publicly listed company? And it has made you think, what does it exactly mean? And what risk does it present? I know I have. Hello and welcome to another KYC Lookup video where we bring you AML related content to help you enhance your knowledge in the fight against money laundering. Before diving into today's video, be sure to subscribe so you don't miss out on any future videos. Oh, and don't forget to leave us a comment with any suggested topics you would like us to cover in the future. Okay, so what is a publicly listed company? A publicly listed company, in simple terms, is a company whose stocks and shares are intended to be freely traded on the stock exchange. Public companies are formed within the legal systems of particular countries they are registered in. For example, in the United States, the public company is usually a type of corporation. However, a corporation may not be a public company, whereas in the United Kingdom, a public company will usually have a public limited company as the legal form, or simply PLC as it's also known as. What are the advantages of a publicly listed company? Publicly traded companies are able to raise funds through the sale of stocks and shares. Privately listed companies can find it difficult to obtain funds as it must come from a smaller set of wealthy investors, or banks must be willing to risk typically large investments. The media, analysts and general public are able to access information about the business as the company is legally bound to transparency. Because many people have a vested interest in the company's success, the company may be well known in the public domain more than a private company. And retail investors from the general public are able to own shares or a stake in the publicly listed company. What are the disadvantages of a publicly listed company? Increased government, regulatory and public scrutiny. Listed companies are vulnerable to increased scrutiny from the government, regulatory bodies and the public. The company must meet mandatory report standards that are set by government bodies within the country they are registered or listed in. Strict global accounting standards. Publicly listed companies globally are required to prepare their financial reports in accordance with the International Financial Reporting Standards, the IFRS. Shareholders are also entitled to key documents on the business activities of the company, which can result in being circulated in the public domain due to anybody holding a share will have access to it. The original owners lose control and ownership of the business. Although not in its entirety, it is significantly reduced compared to the private companies as soon as the company goes public. Difference in vision. Appointed boards of directors may have different aims and goals to those of the shareholders. Are all companies required to be publicly listed? No, although it is worth highlighting that a high number of publicly listed companies actually started as private companies, and over the course of the years, they went public as a way of gaining access to a wider pool of funds to finance their business operations. There is actually no obligation of any company, regardless of size, to go public. In our video, Top 5 Wealthiest Families, we cover some of the biggest companies in the world which are still under private ownership. How to identify the beneficial owners of a publicly listed company. As previously highlighted, publicly listed companies are subject to more scrutiny, which means it will have more information publicly available than a private company. Most recognised exchanges within the company profile will have data on any majority shareholder, whether it's in retail or institutional investor, and the percentage held compared to a number of shares issued. An alternative to finding the ownership would be within the latest annual report of the listed company. Many listed companies are majority owned by another company or institutional client, as they are known, and can result in no actual natural person being considered the ultimate beneficial owner. When faced with this scenario, it is a natural person with significant day-to-day control of the business who should be noted as the beneficial owner. What does a money laundering risk does a publicly listed company present? The risk of money laundering can be found under any type company, even a listed entity. However, if the company going through the onboarding process is listed on a recognised exchange, it may be eligible for a simpler level of diligence due to the international disclosure standards that they must meet being part of a recognised market. Nevertheless, the diligence performed should be in line with your internal AML policy and procedures, with any suspicious item or red flag identified raised to the business AML compliance officer. Let's recap the key points of a publicly listed company. Trades its stocks and shares on a stock exchange. More reporting requirements and scrutiny than a privately held company, which helps to reduce the money laundering risk. Easier access to capital than a privately held company. And ownership disclosure is a requirement for publicly listed companies. So, there you have it, a quick introduction to what is a publicly listed company, its advantages and disadvantages, as well as how to identify its ownership. Tell us in the comments section which listed entities attract the most attention and why. Thank you for watching the video, and if you made it this far, don't forget to like and subscribe to watch more amazing videos.